What is an index? In finance and investment, an index is a measurement tool used to gauge the value and performance over time of a particular market or market segment. An index's primary goal is representation. In a single number, the index accurately reflects the collective worth of a chosen group of underlying financial instruments, like shares, bonds, currencies, commodities, or real estate. An index can be designed to represent a particular market, sector, asset class, or investment theme. And the selection of its components, exactly what goes into an index, has to follow a consistent and transparent set of rules so that its users know precisely what it represents. There is nothing arbitrary about the way a good index is constructed. The point of all this is that an index enables investors to follow the trends and performance of a specific market or group of securities without all the complexity and expense of having to track every single individual security. Any change in the index reflects a proportionate change in the market or sector that it represents. So, an index is like a thermometer. It enables you to take the temperature of the underlying market, whether it is rising or falling. From large cap stocks to fixed income, from global real estate to emerging markets, there are tens of thousands of indices tracking the markets today. Certain indices showing the performance of the share markets of the UK, US, Europe, Japan, and other major economies have become brands in their own right, precisely because they are accepted as representing those markets thoroughly, transparently, and objectively. All indices have a few parts in common. The exact group of securities making up an index is known as its basket. The proportion of the basket each security makes up is known as its weighting. An index's value is a single statistic that describes how the total basket of securities has changed over time. However, index values are more commonly described in percentage terms of how those values have varied over a given time period. So, for example, the FTSE Emerging Index is an index that represents emerging market stocks. Its basket includes 850 large and mid-cap companies in 22 emerging markets. Each stock is weighted by its market capitalization. In other words, its importance within the index is determined by the stock market value of the company. Recently, the FTSE Emerging Index's value was around 100. From 2011 to 2012, the index rose 18%. You may be wondering, can I invest in an index? The answer is no. An index isn't a physical package of securities you can buy. It's a mathematical construct. That means you can't directly invest in an index. But you can invest in products that track indices, including mutual funds and exchange-traded funds. Investors use indices in a variety of ways to assess at a glance the performance of markets, sectors, and assets, to gauge how well an active strategy is working, to evaluate a market or asset's risk profile or diversification potential, to build investment products such as ETFs or mutual funds that replicate an index. Want to learn more about how indices work? Visit the Index Education Center at FTSEangle.com.